starting with the market, then looking at the operator, looking at the specific deal. You can use that really for any asset class. And again, it doesn't mean just because someone's never done a deal in a certain area or the market's not growing or there's some weird things with the deal, doesn't mean we won't do those things. It just means you want to have a good understanding and you've looked at all three of those pieces.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
Hey, everybody. Welcome back to another episode of the Work Hard, Invest Harder podcast. I'm your host, Justin Dixon, and I've got Bronson Hill on the show today. Really interesting conversation about a lot of different things. We unpack his kind of career as he started out in med sales, making a couple $100,000 a year, but really wanted to have control over his time. And so he started investing in single family and realized that maybe he wasn't going to scale quick enough, and then moved over to doing larger multifamily syndications. Over the last handful of years, he's raised over $35 million and has also expanded out into other asset classes. We talk about investing in ATMs. We talk about investing in oil and gas and mineral rights. Very, very interesting. He's also got a book launching called Fire Yourself. So let's get Bronson on the pod. Bronson, man, thanks for being on the pod. Welcome to the podcast.
Hey, I'm really excited to be here, Justin. Thanks for having me.
Awesome. Let's get started here. Why don't you give a quick intro about who you are and Bronson Equity, and then we'll unpack some stuff.
Yeah, so I was a well-paid medical sales professional. I was working with surgeons, mostly heart surgeons. I've been doing that for 10 years in the medical field. Good job, got paid well. I was making over $200K a year. Probably could do it in 30 hours a week. I just really wanted to have more control over my time. A lot of people think financial freedom. Financial freedom really means time freedom, that I can travel, that I can do things at midday. If I want to take my daughter on a camping trip, I can do that. So I started looking into ways to do that. I've been doing single family for years and just realized it was going to be way too long of a process. It would take 10 to 20 years. It wouldn't have gotten me there quick enough, the route I was going. And so I have a relative who was doing multifamily. He's been doing multifamily for years. Said, why don't you do multifamily? And I said, well, I don't have the money. He said, you can raise the money. And so he taught me about syndication, said, listen to this podcast, go to this event, read this book. So I did everything he said. And then within about 2 years, I had raised about 15 million and was getting ready to leave my job. So it went pretty quick for me, as far as it's not just all up and to the right, but it's something that there was such a compelling reason to get involved in multifamily syndication, other types of syndicated deals, that it's been a lot of fun. So now I've had over 1,500 one-on-one phone calls with high net worth investors. We've raised over 35 million for our group Bronson Equity in real estate. We have 2,000 multifamily units, mostly in the Southeast. We've got ATM machines, car washes, oil and gas. We're doing quite a bit of stuff in the alternative, especially these days, just because it really allows people to still get cash flow, which is something a lot of real estate has struggled with. But excited to be here, man.
Awesome. Well, there was a lot there. So let's start to peel back the onion a little bit, but let's kind of start out with kind of when it all started. So you said that you were a med sales professional making really good money. And when did you start with a single family, and how did you kind of like think about real estate as like a vehicle?
Yes, it takes me a little longer, I think, to think about it a little slow, but a single family house that I had when I moved to another state for a job is in the state of Montana. And when I moved back to California, I just decided to keep the house and rent it out. And so I had realized over the next, it was like 8 or 10 years, like, hey, this thing's worked out pretty well, right? And so I've been going to meetups, I've been going and doing things. I just really didn't actually take action. I didn't really take much action. And that's, of course, the difference, the person that takes action versus the person that just has a great idea or great theory or sees it but doesn't do anything. I've shifted my life a little bit more to be somebody who takes action. But so that's how I got started. And then I started scaling up, doing the single family portfolio, and then realized it was just going a lot slower than I wanted.
Yeah, I feel like that's a lot of people's kind of journey is they start single family because it feels safer, right? It feels like attainable and you can kind of do one and then buy another one and it's kind of easy, if you will. But yeah, the scalability tends to be the reason why people sometimes go up market, if you will, going up to bigger deals and all that fun stuff. And then how did you kind of think about kind of that move, right? Because obviously sometimes it takes a mindset shift to go from, hey, I understand how to underwrite a single family house and I can understand the maintenance and the management, but going to bigger deals, like how did you kind of gain the knowledge and the comfortability to kind of get to that next level?
Well, it's funny. I have a story on this there. It's related in the sense as my first house I had And I had a property manager, and there was a night that I actually got somebody reach out to me. It was like a neighbor reached out to me on Facebook Messenger. I didn't even know. It was like, hey, I think there's a problem with your house. And so I guess that Friday night, there was all these people there. It was like 50 people at the house. Rick came through the front window of the house. And then I realized, like, turning that over, we changed property managers, obviously, and it was like $5,000 of damage, different things. But I realized, like, if you have one unit and it's not rented, you have a vacancy of 100%. There's no income coming in. If you have 100 units, there's just so many more efficiencies that take place. If that happened in one unit in a 100-unit building, okay, that was one unit, whatever, and then you still have 99 or however many would be, 90 would be filled up, whatever. So I think the mindset really, what I realize is, again, just a lot of times we think, I've lived in a house in my life. Most people have lived in houses at some point, either apartment or house. They've thought, oh, a house feels achievable. I've lived in a house, I've owned a house. If I just rented one of these out and I just got a few more, I'd be great. But the challenge, especially a lot of people I work with, is that they have money. And if somebody's making over $100,000 a year, a single family may not make sense, because just by you managing, or even if you're not the manager, you're still getting those headaches and those calls about, well, it's not working. The tenant's not paying. And we actually expanded into the Cleveland area. And Britain was not the best tenants, right? Tenants weren't paying. Cities were tough. It was just it never worked out the way that we thought it was supposed to work out. And so even then, if we made a lot of money, we might make like 10 grand on a house or something, or we make a certain amount over a period of time, versus if you can scale. I mean, all it is, people think, oh, I could never raise millions of dollars or go buy a $10 million or $50 million place. It's like, well, you can. It's just math, right? It's just getting a mindset that somebody else has done it. If I've done it, if you've done it, there's no reason why anybody else can't do it, right? So when you think in terms of scale, it's really how you can scale your wealth as somebody who operates it, or if you're somebody who is a busy professional where you can grow wealth without having to get those calls and the toilets, tenants, and the trash and those kind of things, you're less involved. So the mindset, I think, is really just, how can I actually scale this? When I have calls, I ask investors, I say, I've got 4 houses or 5 houses or 10 houses. I say, well, if you were to 10x what you're doing, could you actually pull that off, right? And most people are like, oh my gosh, like, I've got 3 houses. There's no way I could see doing that, right? There's no way. But passively, you can. And even when operating or being a part of some of these bigger deals, you can.
Yeah. So let's talk about some of those bigger deals that you're working on. And so I guess, how long ago did you kind of make the shift to these bigger deals? Like, how many years ago was that?
It's been about 5 years, coming on 5 years, followed by 5 years now.
Okay. So let's go back to that first one, because obviously the first one, going from single family to multifamily, can be a leap, right? And so did you get into that deal by raising money, or how did you kind of get involved in that deal? Or was it passive? Like, what was that first one look like?
Basically, the first deal I got into, when it comes to looking at bigger deals, a lot of times tend to pick things that are a little hard to get into. When I was in medical sales, they wanted somebody in medical sales who had medical sales experience, right? But how do you get the experience if you've never had? So you had to try to find another way. So same with multifamily syndication. A lot of times people don't want to invest with you when it's your first deal, right? So how do you do that? And a great way to do it is you can position yourself as a leader, maybe not necessarily an expert, as a leader. You can also find partners that you can kind of partner with. So what I did is I ended up starting a meetup in Southern California, and been going to a meetup, and I approached the meetup leader and I just said, hey, you have a general real estate meetup. What if we did one just on multifamily? And I said, I'll do all the work. He said, that sounds like a great idea. You do all the work, I'll show up.
Perfect.
So I showed up, we promoted the heck out of it. We had 60 people there at the first meeting. At the first meeting, Justin, this guy I've never met shows up and says, hey, I'd invest in one of your deals. And I was like, are you talking to me? Like, right. I didn't have a deal. So I said, but my sales background, I was like, oh, let me get coffee with this guy. So I got coffee with them, and I showed him a sample deal, just a 2-3 page, like, here's what a deal would look like. Would this be of interest to you? These numbers. And whatever. I say, oh yeah, I'd probably invest $100K in something like that. And I said, okay. So then I basically found someone from that same meetup that had a deal that was looking to raise capital, and I connected the two people, right? So a lot of times capital involves finding investors, connecting with a deal that makes sense. So a lot of people think you've got to know all the paperwork, you've got to know the legal, you know, all the stuff when you start. You really don't. I mean, it's just finding a team member, and this team member had been doing multifamily for over 15 years, and they had a track record, so I was able to connect them, and that was the first 100K. And I think that's, for most people, that's the hardest thing if you want to be active, is just getting your first deal done, you know, going from 0 to 1. Right. And so that's one way to do it. That's one way you can. Another way that's, I think, a side door to do it is you can basically approach an operator and say, hey, if they're looking to raise money, hey, can I help you raise money? I think I can raise 500K. You put 50 to 100K of your own in the deal. And then you tell your friends, you send them a personalized email that says, hey, Jeff, I'm investing in this deal personally. I thought you might be interested in taking a look as well. Right. So then you other people invest. And they don't know you're doing it as a money raiser. You're just saying, oh, as a friend, I'm letting you in, Justin.
Yeah, bringing you this opportunity. It's from the kindness of my heart. But
then, and then maybe you end up with 200,000-300,000, and most, if you started at 500 as far as getting into a deal, and then it gives you ability to learn other aspects of the deal, and you get to be a part of a larger deal like that.
Yeah. And so it sounds like you've kind of carved out a niche in more of the capital raising side of deals, because obviously there's multiple facets and multiple kind of parts of a 100+ unit apartment complex. It's not just one person can buy a single family, one person can manage it and do all that fun stuff. When it comes to these larger 1, 2, 300 unit deals, it takes a village, right? You got the person that found the deal or the people that found it. You've got your lender, you've got capital raisers and other general partners that are making up that kind of management team. And then you've got these massive amounts of limited partners who are bringing capital to the deal to help you actually take that deal across a finish line and actually close it. So is that really the area, the capital raising side, is that really where you're focusing? Or do you also do any of the kind of acquisition side and kind of trying to find deals yourself?
We have about 150 investors invested with us. And I had one who asked me recently, hey, did you just sit at home and do podcasts all day? Are you actually doing it? I'm doing more than that, okay? Like I'm a lot more. So with the deal, it can be tempting to think, hey, I'm just going to do all this, and all of a sudden I'm going to have all these deals and these investors and whatever. But there's a lot that goes into it. And I think of the different aspects of a deal, I'm not the one finding a deal, but I am doing diligence. We see a lot of deals come across our plate, and we look at them and evaluate them, and we say no to about 98% of them. But if it's a deal that makes sense, and we'll do our own underwriting, we'll go out to a property, we'll visit it, we'll look at competing properties, we'll make our own kind of assessment there, and then I invest my own capital, usually the team will as well. And then a part of the asset management, I'm not typically the primary asset manager. There's usually I like to have somebody on the team who's got 10, 20. I got one part who's got 30 years of asset management experience.
Yeah.
And so that's the thing I like a lot of people don't realize is when you have a team, it doesn't matter. Inexperience in managing large multifamily is not an issue. I had a partner that had 30 years of experience in that particular asset. So that's a big deal. And then there's two parts of capital raising. There's raising capital, and then there's what's called investor relations, which is what happens after a deal closes. So those are two separate things, right? So those are also things. So of these like 7 things, finding the deal, I'm involved in basically every other step besides finding the deal.
Got it. Well, you mentioned asset management, and I want to dig into that in a little bit, but we're going to take a quick sponsor break, so we will be right back.
Whether you're trying to hire a full-time employee or a contractor to fill a gap, Hire Tomorrow can help. Hire Tomorrow is a boutique recruitment firm that has successfully filled sales and marketing, human resources, and technology positions with companies ranging from startups to Fortune 500. If you're struggling to find the right talent, check out hiretomorrow.com or reach out to recruiting@hiretomorrow.com to see how they can help.
All right, we are back on the Work Hard, Invest Harder podcast. We've got Bronson Hill. And before the break, we're talking about kind of the different parts of a multifamily deal that you can get involved in. And one of the things that I think is really key right now, especially recording this in early mid-July 2023, is asset management. If you've been involved in multifamily real estate the last few years, 2021, the market saved a lot of bad deals, right? And now we're in this higher interest rate environment, and you really need to be a really strong operator to manage these deals. And part of that operations is property management, which is your kind of people that are boots on the ground, the third-party management, or if you have your own management team. But then you've got this asset manager, right? And so maybe talk through some of the deals that you've seen where asset management has been kind of the linchpin to kind of keep these things afloat and actually achieve the returns that you're telling investors that you're going to actually achieve.
Yeah. So since March of 2022, so the last year and a half, it's been an uphill battle for a lot of deals. We were seeing about 80, 90% less volume than we were a couple of years ago. We're seeing a lot lower volume. A lot of it has to do with interest rates. My friend Ken McElroy says that 2023 is the year of operations. Now, what does he mean by that? It means that if you can operate a property well, you're going to do really well. If you're not, you're going to be struggling. I think in the past, there's the idea that rising tide raises all ships. So if you just bought in a good market that was growing and generally rents were going up, everything was great, right? And so we've seen, at least in some of the areas that we're in Jacksonville, Florida, which is a great market. It's business friendly, landlord friendly, population growth, job growth, income growth, all those things, rents are growing. And we're just seeing 10,000 new people move there at least every month, right? So there's a lot of great positives. The challenge is Insurance has come up 3 to 4 times what it was. We can project 4x increase in insurance. That's kind of crazy. Labor costs and material costs still 30 to 50% higher in certain areas. Not every single product, but certain products. So we're seeing things going up. We're not seeing rents rising that much. And then, of course, a lot of our stuff is we have interest rate caps on our stuff. So it's limited at 6% or 6.5% interest, but you're still paying a higher interest cost, even though you have caps on them. Right. And so I think that really before you could be a little more loosey-goosey is just, hey, just make sure that you're above 70% occupancy. Well, now if you're not running 85, 90% occupancy, you could be running negative on a deal, right? That's where you start to get in, hey, we're negative cash flow. And of course, as rates continue to rise, this is really where operations is such a big deal. And when in a value add deal, like kind of what we've been doing, where we'll take 300, 400 unit property and we'll say we need to renovate 50 to 80% of these units over the next 2 years. That to us is what Warren Buffett calls our margin of safety, right? The margin of safety is just if things don't go exactly the way we set out, we still have some margin there. So renovate, we can get there. But the problem is if you renovate too much, you fill them up quick enough, you're running out of cash and you're not working as well. So there's this fine balance of operations, and it really just comes from experience. And then, of course, having the right team, property management. Sometimes we'll have issues with property management, have to switch a property manager or change construction companies. So there are issues that come up and things change. And so a lot of people like to think, oh, every deal is just locked tight. This is what it is. Anybody, when you think about it yourself, anybody's ever owned a house or done a flip or anything, nothing ever goes according to plan. Even if you go like do your bathroom and you're going to do the tile floor in your bathroom, you're up to the floor, like whatever time you thought it was going to take, just like put like 2 to 3x on there. And that's like what it usually takes, right? You get, I got to replace the floor's bad. I got to do that. Now I got to do this. And so I think it's kind of like that in some of these deals. So operations, really good operations is key. And there's really, in my opinion, no substitute for just length of experience and being exposed to different things.
Yeah, I've seen a lot of deals that I'm involved in and that other people are involved in that if this would have happened in 21, again, interest rates were low, rental rates were going up faster than anybody projected. So the market saved a lot of deals. And now, as Ken said, this is definitely the year of the operator for sure. I'm kind of curious because you do a lot of capital raising, a lot of investor relations. How do you communicate to investors when you have these deals that are maybe not going exactly to plan, right? And a lot of times these are 5-year deals and maybe this is year 1. So typically you have time to make up the back end, but like, how do you communicate not great news to the investors that have put money into deals?
Yeah, so I think the biggest thing, I've been a passive investor before as well. I'm still passive invest beyond what we do in our multifamily or other assets. And I think one of the worst experiences as a passive investor is just something's going wrong in a deal and you didn't hear about it for 3 to 6 months or more, right? There's no reason why that shouldn't be communicated, right? So I think when you deliver bad news, it does develop trust. That's also a Ken McElroy quote as well. It's just delivering bad news, especially early, develops trust. You just think of it like, hey, this is not just trying to impress people. We're not just trying to get them to invest more. We're trying to say, hey, can we create something that is a long-term partnership? And it's really about, it's like if you have your relationship with your spouse or you have your relationship with neighbors, you want to do things in a high integrity way so that people hopefully 5-10 years from now say, man, that was the best decision we made. We're with Justin or we're with Bronson. Right. So those are things that we try to do. But I think in general, just managing expectations. When something's not going well in a deal, sometimes you'll get a lot more calls, you get a lot more emails, it'll be a lot more work. If everything's going great, it's like the emails you get are like, you're awesome, you're great. And I was thinking about this the other day. This is kind of more of a personal faith thing a bit as well. But I was thinking about reading this book, talking about it, but the idea that like, who do we work for, right? If you're a syndicator, like who do you report to? Who do you work for? Well, I think we work for our investors. True, but I even have it to a deeper level of like, well, I think we're really working for God, right? Because I think if we put it at the investors, you can be loved by investors 1 month and scorned the next month. And if that's really what drives you, it'll just tear you apart inside. So you've got to have some higher like accountability that, hey, or even it's just your own personal standard. I'm doing this because I'm trying to achieve a certain level of excellence, right? But anyway, otherwise it's challenging because you'll get a deal that won't go well and all of a sudden the investor upset with you. And it's just like, well, that's not what we do, whatever. So, well, we're doing the best we can. And this is how we're solving this. I think just really being open with communication and being as open as you can with investors is really helpful.
Yeah, I would say no news is not good news. If I'm an investor, I'd rather hear bad news than nothing, right? Because the last thing you want to do is hear really bad news 6 months into a bad time. And you're like, oh, well, actually, now we need to ask you for additional capital to keep this thing going, right? The dreaded capital call. So that's obviously the last thing you want to do, to ask your investors to kind of keep funding a deal if it isn't going as well as planned. But yeah, I would say open communication is definitely probably the best remedy to keep people informed, because obviously these are investments, right? This is not a guarantee. We don't guarantee results. we're investing alongside our investors, right? And we have every incentive to make sure the deal goes as well as possible. I definitely agree that communicating something is better than nothing. So you talked about Jacksonville. What other markets do you target? It sounds like you work with a handful of operators / deal finders, and you're the person that they go to help them bring in some additional equity into the deal, right? Additional investors. So how do you vet people bringing you deals saying, hey, Bronson, we'd love you and your team to help us get this thing across the finish line? Maybe talk through that first, kind of some of the things that you look for an operator to work with.
Yeah, so I've got my book coming out called Fire Yourself, Replace Your Working Income with Passive Income in 3 years or less. There's a chapter dedicated to vetting deals or vetting operators. How do you find, once you get a deal, how do you vet it? So I think in any market, whether it's a multifamily market or it's the ATM machine or the oil and gas, you're going to have 3 different levels. The first one, that's kind of like a funnel. So you have like the market is at the top, then you've got the operator in the middle, and then the deal is at the bottom. Now, it usually comes to you in the opposite way. Here's a deal. So you're getting the deal first. But you've got to come back and say, hold on. What is this market? Is this market of something that's interesting to me? Is the market growing? Is it shrinking? Is what's happening? And for example, in Jacksonville, Florida, or whatever area it is this, I mentioned some of the characteristics of that market. We like that market for these reasons. There's some downsides of the market. We look at the market as a whole. Then we get into, okay, who is the operating team? Is this the first of a deal they've ever done? Or if they've done other deals, is this the first one in that market? Maybe they're great in Jacksonville, but this one's in Little Rock. Well, hold on, let's figure this out. So we've got to it's not that's the deal breaker. It's just saying, let's figure out exactly who this operator is, what they want, and really what do they value? Again, I used to feel like everybody valued the same thing when it came to investing, but different operators function very differently. And our core values of transparency and communication, long-term partnership, and conservative underwriting, that's not everybody's values. Some people don't, they want to raise the money and don't talk to investors at all after that. I'm like, that's not what I want to do at all. So that's going to be an issue if we're working together, right? So the operating team, their core values, and then, we'll do background checks and things if we feel like it could be a fit. And then we'll look at a specific deal and we'll say, okay, what's the business plan? Does the business plan make sense? Warren Buffett says we only invest in things that we understand. If we don't understand the business, we're not going to understand it. If we understand both how we can make money, what's the goals, how am I going to make money on this? And then really, I think this one's even more important. What are the 1 or 2 primary risks, the ways that you could lose money? And every deal has them. Every deal has them. And if you don't know what it is, when you look at a deal, you probably haven't looked hard enough, right? Or you just don't understand it enough. Yeah. There's always 1 or 2 primary things. That's something I usually always ask an operator. Hey, when you look at this, what do you see as the 1 or 2 primary risks, right? And you see if what they say matches what you say, or if something kind of like, well, that just seems like a really obscure thing. Like, well, they're not even looking at this realistically, right? Yeah. So I think kind of starting with the market, then looking at the operator, looking at the specific deal, you can use that really for any asset class. And again, it doesn't mean just because someone's never done a deal in a certain area or the market's not growing or there's some weird things with the deal, doesn't mean we won't do those things. It just means you want to have understanding and you've looked at all 3 of those pieces. Yeah, no, I like that. And it kind of helps you build that know, like, and trust triangle that everybody wants to get to, right? Is making sure that you know somebody. And that's kind of maybe your first inkling is kind of understanding a deal. And then you start to work with them. So you start to get to know them and trust them. And then you move forward and go from there. So what markets do you like outside of Jacksonville? It sounds like Jacksonville is an area where you have a lot of investment, or what other kind of general markets, high level, if you will? If you see a deal come through that's in that market, at least, hey, it checks that box of like, yep, I know the market, I've invested there, or I like it and want to invest there. Yeah, so we like the Sun Belt, and generally Florida's great. We have some stuff in Georgia and Alabama. Right now, honestly, we're open to different areas. We haven't done a lot of multifamily lately for 2 reasons. One is you having to put typically more money down. I mean, the deals don't quite look as good as they did a couple of years ago. It's not that they aren't there. They just don't look as good. I think so you have to have more tempered expectations. You've got to just be, and there are some assumption deals where you're putting 50% down and assuming a loan. And there's some things that make sense with great operators. We've considered some of that. But I think I've also seen investor appetite soften a little bit toward real estate. So we're seeing kind of on both of those. But some of the alternatives we're doing, we're seeing a lot of interest on all that stuff as well. So we've shifted a little bit to look at some of the alternatives just because we like the cash flow that are in these deals. I think if you were to put head to head, would you rather have appreciation? Let's say you had a 15% return when a property sells in 5 years, or you're able to make that 15% or 10% kind of just cash flow pretty quickly. Cash flow would be more beneficial because you actually can live off of that. You can replace income, you can reinvest, you can do other things with that money versus having to just have it someday. So I think I have a preference personally to cash flow. Not everybody's situation is that. So I'd say Southeast markets for multifamily, but also being open to other assets as well. Yeah, I wanted to dig into that. Actually, that was my next question is what other assets are you looking at? Because I've started to
to look at, I've been very heavily focused over the last couple of years on multifamily syndications, similar markets to kind of what you mentioned, but I've started looking at like Airbnb and some self-storage and some other things. So what are some of the other asset classes that you're seeing that have still strong returns and maybe have a little bit more of that cash flow flavor to them?
Yeah, I think really for us, we'll look at different things that, for me, the first one I got into really outside of real estate was ATM machines. And some people think, man, do people use ATM machines anymore? And it's ironic that actually about 4.5% of US households, the FDIC came out with a report and said that not a single person in that house has a bank account, which is kind of shocking, right? So that's 1 in 25 homes, not one person in there has a bank account. There's people, the stats show people are using this stuff. So again, once I started getting in, I invested personally, and then I just love the consistent cash flow. And then I did a bunch more diligence and continue to do diligence and just found an operator I really like. And then we've been able to bring a lot of funds to that. But I think it really, every investment too, there's different goals for it. It usually comes down for most people either to cash flow, replacing expenses type of stuff, or if it's a retirement account, it's more like appreciation is more important or it doesn't really matter. It's just as long as it's there, or it's reducing taxes. So a big one for reducing taxes is oil and gas. Oil and gas actually has some very unique attributes to where you can actually have ordinary income. So if I'm a medical sales guy making 200K, if I invest 200K in an oil and gas deal that does drilling, often, again, this is not tax advice or any specific deal, but I can get around 80% of what I invested as a reduction in my income, my taxable income. So instead of being taxed on 200K, I'm taxed on 40K, which is almost nothing, right? So you not only get the returns from the deal, which are pretty good if you're in the right type of deal, you also get the taxable benefits, right? And you say, well, why would the government do that? Well, they do it because we need energy. I think the current administration is not super energy, shutting down the Alaska pipeline and other things that they're doing. But I think that in general, we need lots more energy than we have. So there's different incentives historically that have been there for that. So there's different attributes of different types of assets that provide different things. And I think when you're open to it, it allows you to kind of see, oh, wow, this actually looks really interesting. And with our multifamily investor eyes, you can kind of see something else and be like, oh, how would that work? And it just allows you to really find other opportunities.
What are you investing in oil and gas? Is it like a piece of land that they're going to explore, or what are some of the attributes of oil and gas investment?
So there's different things we've done. We've done one that's a little more technology in the oil and gas space. That one's less, it doesn't have quite the tax benefits that I mentioned, but it's a much higher upside, potential like 10 to 100x type of thing. And so there are investments out there with those type of returns. Other ones working with mineral rights. So you have mineral rights and operating rights. So it basically has to do with somebody will own the land and then somebody will own the mineral rights. And those can be two different people. And when you own the mineral rights, you actually have the ability to lease that. So you have basically operating either working interests, so the ability to lease that out, or you can say you either have operating interest in that or non-operating interest. So if a group goes in and says, hey, we're going to buy the mineral rights, or we're going to buy a lease for this period of time for these mineral rights, then we can partner with operators that are established, or if there's already drilling in that area, we can basically participate with them. And it gives us the opportunity to really grow capital by partnering with a major driller. So the way it's been explained to me is that, and my background is I'm not an oil and gas engineer, but you'll have kind of like areas where they do a lot of oil and gas drilling, kind of a tier 1, you'll have a tier 2 where there's some as well. And then 3 and 4 kind of like you're much less likely to hit something, but technology's improved so much. It used to be you just do horizontal drilling and it'd be hit or miss and you just kind of be guessing, right? Well, now they can put with electrical current stuff, they can tell with a pretty high, they can just put out like graphs of where the stuff is. They know it's down there. And if they miss, they can just turn the drill and go sideways. Like it's really wild.
Got it.
So now it's like you would have some misses. Now it's like it's much more likely you're going to hit where you're going. And if you're working with reputable operators and things, it can be really positive. So
interesting. And how does the ATM fund or ATM deals work? Are you investing in like, hey, I own 50 ATMs across these 3 campuses, just to use like college campuses, or I don't even know if they use ATMs at campuses anymore, but what are you investing in? Physical machines that are you're getting cash flow based on usage, or how does it all work?
Yeah, so the operator we worked with is the 4th largest operator of ATMs in the country. And what will happen is about 99% of these ATM machines go into existing locations. So let's say you're an owner of a restaurant or you have a hotel or something. And we'll go to you and say, hey, we know you have your ATM. How's it going? Are you happy with it? And usually you're happy with it because you're getting 30% of the revenue that comes in through the fees, right? So you're getting paid for doing nothing, just for having the space.
Yeah.
So we'll say, hey, great. Justin, how would you like a new ATM machine? We'll put a brand new one in here with a big screen and everything. They're like, oh, that sounds great. So, okay, great. We just need you to sign a new contract so we can basically get that to you. And that's a 7-year contract. And basically what it does is it secures the cash stream for the investor. So the money goes basically just to replace those. And then the investor becomes a partner in the deal and they get paid out. Typically, the difference between multifamily, I have a chart on this in my book, but typically you get kind of no cash for a little bit, then you start getting some cash flow, whatever, and you get this big lump sum at the end, right? You get this big pop at the end because you get your capital back and whatever, you're getting most of your money. You invest 100K, usually you're getting like 50K return, and then you get another 50K at the sale, and then you get your 100K back, right? So you typically big lump sum at the end. Well, this one, you're getting paid out so much, you're getting paid along the way that maybe half your money comes back to 2.5 years. You can reinvest that. And after 4 years or so, all your money's back. This is all just potential or not something specific. And in 7 years, that deal will end and the cash flow will just stop. There's a small scrap value for the ATM machine, and then the deal just ends. So that's kind of how it's structured, how it works. It's different, but it is the one that we're involved pays out monthly. And I just love the consistency of it.
Well, yeah, it's like one of those things where it's good from a diversity standpoint, right? Because you may be like, hey, I really want some cash flow. So you invest in a debt fund or an ATM fund or something like that, that'll give you consistent cash flow. And then you're like, but I also want appreciation. So maybe you go invest in real estate that doesn't have a ton of cash flow, but you're betting on 4 or 5 years that 100K that you invested is going to turn into 200 or 250 or something, right? So you kind of are getting the best of both worlds by diversifying across a couple of different asset classes.
Exactly. Yeah. And that's, I think, the benefit too, is when we're a one-trick pony and all we do is one asset class, whether it's single family or multifamily or self-storage, whatever, that's all we have. And all we see is what's there. But when you kind of broaden it's like when you're able to broaden your perspective and look around, you go, well, what about this over here? What about this over here? And there's just been times historically when it's been a great time to buy real estate, or it's been a great time to buy a certain asset. There's Mike Maloney, who's a guy who did something called The Hidden Secrets of Money. He's on YouTube about this, where he says, if you were to just basically take 3 assets, meaning you had, or actually just 2 assets, you had gold and you had physical gold and you had real estate. At the time, if you were just bouncing back and forth between the two, you could have just made 1,000x return over 100 years or something just by figuring out, okay, is this overvalued or undervalued based on what we're seeing? It's valuation metrics, right? So when cap rates are super low, well, maybe it's time to start finding other assets that can work. That's kind of what we started doing as well.
Got it. I wanted to shift a little bit to some of the conversations that you have with your investors that you talk to and people that you're meeting. Because a lot of people listening to this podcast are hardworking professionals. They have a W-2 job. Maybe they're in similar fields to what you were in sales. So you're making you got a base salary, but you're making a lot of commissions, right? And so you want to figure out other options to invest that capital outside of just the stock market or your company's 401k. So what are some of the things that your investors are saying now that maybe is different than what they were saying a year or 2 years ago with the change in the real estate market? What's the appetite right now for the different asset classes that you're offering to your investors?
Yeah, it's a good question. How has it changed? I think we've shifted a little bit. So I have the perfect example because there's certain times where you have a story. We had a deal in Jacksonville we bought in 2021 and we planned to hold it 6 years and we sold it 10 months later, for 80% IRR or something like that, and 1031 into another deal. So that's awesome. You have a deal like that, you share that, all of a sudden you guys, people reach out, hey, I'm interested in that, whatever.
Right.
We're not seeing too many of those deals.
I want to do that exact same thing. Do that
exactly.
again.
Yeah. So I'm going to invest right now. And it's interesting. We have people, there's actually a well-known operator friend of mine told me about that on their website. And this is somebody you probably know, but they have on their website 50% returns has been their track record the last few years. They've got this published that they have a 50% return, their average annual return on all their stuff. He's like, man, those guys are geniuses. I got to get another stuff.
Right.
Well, just because that's happened doesn't mean that's going to happen over the next.
That's not a predictor of the future necessarily.
Exactly. So I think for me, one thing that Steve Jobs did that was interesting, he didn't go around ask a bunch of people, hey, what do you want? Basically, he created the opportunity of the iPhone, or he created the opportunity of the iPod. And he told, hey, this is really going to help you with what you need. And then people jumped on, right? So sometimes people don't know exactly what they want. They can say they want one thing. They say, oh, I'm scared. I don't know. Well, I feel like inflation really, even though they're saying it's 6% or so, I think it's more like 15%. And I think inflation is really tough. And so I think getting out of cash, if people have hundreds of thousands or millions of dollars in the bank, I don't think that's a good move right now, right? No specific advice, but I'm mostly invested in stuff, especially things that cash flow or pay me to hold them, because I know there's going to be a hedge built in there as well, an inflation hedge. So I think what a lot of people, like I said, they typically have a goal in mind. They're either high earners trying to reduce taxes, A lot of people have a money problem where they're like, they don't have money, they have money, they don't know where to put it. So you're basically there to be a coach and try to help. And then really just trying to find opportunities to invest that really make sense, that they can reduce risk and get started with a new way to move forward.
Yeah. Are you seeing general softening in the appetite of investors right now to be like, hey, especially if they're like historical multifamily investors, right? Whether that's either hesitation to pivot to a different asset class because maybe they're not as familiar with it, right? Or just they want to stay in multifamily and there's obviously not a ton of deals. So like, what's kind of the sentiment there?
Yeah, I haven't really polled my investors. That'd be a good poll right now to do, is just say, hey, what's your sentiment toward multifamily and what's going on? I don't have I've had a couple investors reach out like, hey, when's the next multifamily deal? What's going on here? And we had some stuff for non-accredited. We're starting to do more accredited only type of deals, especially some of the stuff outside of real estate, just because it does involve a little more sophistication. So that's kind of what we've been doing. I do think it has softened a bit. Everybody I've talked to in the industry said, yeah, we're just seeing investor demand. It has softened a bit. It doesn't mean it's over. It doesn't mean there are people, reaching out, hey, I want to invest. And we're still having calls with investors and we're putting things out there and we love what we're doing and we love the investments that we're in. But I've realized that I really think what's going to happen, and I've had this kind of opinion for a while, that we're going to continue to have higher rates until there's some sort of crisis or there's some sort of reason to lower rates internationally. Because I think in 2019, we had the taper tantrum where they raised rates. I was, oh, no, just kidding. We're going to turn it. We dropped rates. Well, that was also in response. It could be in response to how the market perceived it, but also I believe Europe at that time started dropping rates. So China recently announced a big QE policy. They're going to do a bunch of QE. They just announced that this week. So if that's the case, what are we going to do? If we keep raising our rates, what that does, that makes the dollar even stronger, which makes it harder for us to export anything if other places are dropping. So there's different factors there. And again, a lot of it's not actual inflation, it's more perceived inflation. So if they can just say, oh, well, now we're down to 4%, whatever, or 3%, we're down to, it's coming down, whatever, even though it's not, they're saying it is, and people begin to believe it. And then sooner or later, all the Fed has to do is say, okay, rates are here, and now we're just going to leave them here, or even have a slight drop. Or there's some other financial crisis and they've got to bring them down. I don't think it's going to be that long before something happens and they're going to have to make a switcheroo on the rates here.
Yeah. Talking about the crystal ball scenario, just with multifamily, I guess, for a second, what do you think is the rest of 2023 going to look like? I've been seeing first quarter, there was very few deals, and I'm using air quotes, just kind of properties being listed, right? Just because of interest rates being so high and everything. I've seen that tick up a lot in the last handful of months. I think there's still a delta between what sellers are asking for and I think what is realistic. But we're in July, mid-year. What do you think the rest of this year? Is it going to be similar where there's still this kind of gap between reality and kind of what people are expecting from the sell side?
Yeah, I think there is. I mean, there are situations where distress is coming up, but it's not acute yet. There's so much, I don't know if I can't remember how much it is. I feel like it's trillions of dollars that is just in multifamily. Most debt for multifamily is typically bridge debt. So I think something like 80-85% of debt is bridge debt. There's a small amount of fixed rate debt, but a lot of this stuff has to be rolled over every couple of years. Some of it, if you're a REIT or you're some other public group, you can just raise more money and different loan to value kind of things going on. But for a lot of people, there's going to be some pain there. And so it's just really, it comes back to the operations thing. So I think it's going to continue until the Fed really, sad to say, but they're kind of driving a lot of this. Because again, the assets really are valued at what you can get loans for, right? Nobody pays cash for an apartment. So if that's the case. Well, what's the cost of ownership? Well, it has to do with your rates. And so if you're a lender, let's say you and we're having a lending conversation and you're a lender, I'm a lender. Well, I'm not going to lend at 7% now if I know that they're going to raise rates maybe once or twice more and it's going to be 8% by the end of the year, right? I'm not going to do that, right? It doesn't make any sense, right? So I actually be losing money by doing that. So that's why when lending slows down like this, it gets harder to get deals done. I think it's going to continue to be challenging until there's some reason. We saw it a little bit with the Silicon Valley Bank thing and they jumped in and First Republic and some of that. But I do think there are going to be some issues that come up and they'll deal with them how they can. But there's also the black swan stuff that we can't see that happen at any time.
Yeah. I think the rest of this year is going to be a little bit painful. I think the distress ratchet up a little bit on some of the deals that are out there, but we've been talking about this for a while and I want to kind of transition to the end here and talk a little about the 3-pack of questions that I ask every guest on the podcast. So what's one piece of advice that got you started or helped you along your real estate investing journey?
I think the best piece of advice that helped me and I think would help anybody is really, there's a quote that says, you'll be the same in 5 years, except for the books you read and the people that you meet. And so that really brings up two things, right? It brings up education, the books you read, the conferences you go to, those kind of things, and then the networking, right? So networking and education. So those are the two things that if you just simply try to learn as much as you can, you read as many books and great podcasts like this one, you're learning from people you meet. And then as you network, you never know that person you meet, they're going to invest with you. You never know if you're going to work together on a deal. They're going to become a great partner that you invest with. And so, again, just meeting new people and continuing to learn. It's amazing what's possible.
Yeah, I actually really like that. I jotted that down. That's a great quote. This may be a little self-serving, but I'll let it happen. What is your favorite real estate or business book that you're into, or maybe will be into come September or so?
Well, I've got my book, my Fire Yourself book. I think one of my favorite books I try to read every year is a book by Chris Voss, which is called Never Split the Difference. He's former lead FBI hostage negotiator. And so he, for years, was the international, there's like 3 or 4 Americans kidnapped every day or something around the world. And he would just literally be on the phone, like walking people through how you do this. It's so fascinating every way we deal with, and not just like life and death situations, but how we talk with our kids, or we talk with our spouse or with a neighbor, or just kind of create a win-win situation. So I think that's an excellent book.
Yeah, I listened to that book, and then I don't know if Masterclass is still a thing that's out there, but he did on that app Masterclass. Yeah. He was on it, and I listened to his process. I mean, it's very fascinating. The guy's a genius when it comes to negotiations and all that.
I did that Masterclass too. Yeah, I did that Masterclass. It was really good.
Yeah, super interesting. All right, we got final question here is, if you hit your financial freedom number, meaning you can live an amazing life just off of passive income from your investments, what would you do?
I mean, really, I get asked this sometimes. I think I'd just be doing exactly what I'm doing right now. I have a big why is I want to end modern day human slavery in the world, which is a big, hairy, audacious goal. There's 20 to 40 million human slaves today, more than we've ever had in the history of the world. And it's heartbreaking and kind of mind-blowing. Is that even possible? But it's happening. It's there. And so creating more awareness for that. I think really educating people about finances and getting out of Wall Street and into Main Street is incredibly meaningful, because I'm a recovering investment advisor. I did investment advising for a few years, and I just realized like Wall Street doesn't serve people. So we work so hard. You see people like my parents that were teachers, and they work so hard, and then they get to where like there's no help, there's no financial help at the end, right? There's no real education or real tools to help people get there. So people like you, people like me, help provide that for people, which I think is incredibly meaningful.
Yeah, no, I love that. A lot of people that I ask that question to are saying the same things. They're like, hey, I would continue to do what I'm doing, or they would have a passion project, or, really volunteer more. So nobody has ever answered, I'm going to sit on a beach and sip Mai Tais for the rest of my life. So I don't think we're wired that way to kind of want to just kind of mail it in as far as that goes. So, well, you got your book launching, Fire Yourself, you said September. So hopefully maybe this will be launching similar timing as far as that goes. So definitely check that out. But if people want to learn more about you, learn more about Bronson Equity, and maybe invest, or maybe what's the one best way to kind of find you?
Yeah, so I'm on all the social medias. The best way to connect with me is our website, bronsonequity.com. I have a free ebook, which is about 50 pages, called How to Use Inflation to Your Advantage. So instead of getting pained by costs going up everywhere, there's a way you can actually use it to make it your friend. And that's a free download at bronsonequity.com.
Awesome. Bronson, man, really appreciate you being on the podcast. This was a lot of fun. I really appreciate it.
Thanks so much, Justin. Appreciate it too.
Awesome. Thank you.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast. Your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please like and comment. I read every comment as it helps me serve you better. Make sure to subscribe and hit the notification bell. That way you won't miss out on more valuable content. If you're watching this video, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.